I'm Nicole Shanahan, Bobby Kennedy's running mate. Welcome to Back to the People podcast, which highlights the growth of a movement uniting America, where our government is free from corporate capture and where we give voice back to the American public. What's the most apolitical tax policy you could think of that's in the best interest of the American public?
The United States, the sort of, supply side tax cut dynamic that, the playbook we've been running since like 82 or whatever, right? That is a policy that drives a certain outcome when you have a low debt to GDP. Now, if you cut taxes, all you're going to do is increase the deficit. And so it's the wrong medicine given where we are in the economy.
If you are a policymaker or selling something to the American public, the only responsible package you can sell right now is, reduce spending, first and foremost. Work on productivity gains wherever possible. That's in the best long-term interest of the American public. And we've got to get GDP to debt balanced as quickly as possible. What are your thoughts on rebuilding the middle class, and where are, the best opportunities right now?
We need to start changing the incentives around this, broadly speaking. I think if you want to go into finance, you pay your own way in college. I think if you want to go into engineering, or you go into certain sciences, you go into certain technology applications, you should get some sort of subsidization from the government in the same way you might, as going to a state school versus a private institution. Teachers should probably not have to pay, right? If we need to start and restructure from the bottom up. We need very good, very motivated teachers, not teachers who are worried about how they're going to pay their $250,000 in student loans.
This is a moment in time in 2024, running with Bobby Kennedy on an independent ticket that I think really establishes many of the postures that we need in this country right now, which is centrism, which is this ideal that what makes America great is the people who are able to speak freely, think freely, and act freely.
It is. I agree. It's a very important time. I think it's a very important time. It's a very important time to have somebody pushing some of these issues, the way that you guys are.
Luke, thank you so much for taking the time to chat today on the economy, your views on it. I'd love to hear a little bit about your backstory. Where are you from? Where do you live now? And how'd you get interested in this space?
Sure. So born and raised outside of Cleveland, Ohio, and still live there now. Family's still here, etc. Spent some time in Cincinnati. I went to the University of Cincinnati, as it has one of the best architecture schools in the country. And so out of high school, I was going to become an architect. And I did that for about a quarter and a half and realized I did not want to be an architect. So I pivoted to finance and accounting, received my degree from there in finance and accounting. And finance was something I was always kind of interested growing up. I loved playing Monopoly. I loved playing, there was this board game when I was a kid called American Dream, where you would buy different blue chip stocks as you went around the board. And I don't think it was a huge circulation game like Monopoly was, obviously, but I always enjoyed it and decided I wanted to do something in that business. Cincinnati has a great co-op program where you go to school a quarter, work a quarter to get real-time professional real-world experience in between your theoretical education. And so I'd love to say there was some grand plan, but the reality was my high school sweetheart was in Cleveland back home for the summers and winters, and I wanted to see her. And so I found a co-op job in Cleveland at an online money management firm named Ralston and Company that was had a small institutional equity research business. And I began co-oping with them about almost 30 years ago now. and fell in love with that business. Started off in equity research and then in sales. And about a year later, a small group that had been working there left and started their own firm called Midwest Research. And I literally got in the ground floor there. I was sitting as a senior in college on my co-op in temporary office space, licking envelopes and stuffing letters and sending it out to clients to explain that we had left and there was this new firm. So began with them out of college in institutional equity sales, selling investment research to some of the biggest institutions around the country. We were early pioneers in bottoms-up fundamental channel check research. It's something that's done very commonly today on Wall Street, but in the late 1990s, nobody was doing it. Basically, research in the mid to late 90s was pick up the phone, call the CFO of a company, ask them how the quarter's going, and then report to your clients how the quarter's going. And that's great when things are going well in the economy, as it was 93, 94, 95, 96. But as it got into the late 90s and the economy started to slow a bit, it turns out the execs would start lying to you. They would tell you things are okay. And some of it was they had to. By SEC rules, they can't tell you a couple days before the quarter that they're about to bomb the quarter. They go to jail if they do that. So they would tell you that things are good, and then things weren't good. And so we discovered we needed to find a way to get an edge and do a better job for our clients. So we began building out a channel check framework where we were talking with industrial distributors. Basically, you're looking up and down the food chain, trying to build a mosaic for your clients. And we did a really good job at that. And it coincided with a significant growth in the hedge fund industry, significant growth in the commission pool on Wall Street on the institutional side, and the business grew tremendously. We sold that business to First Tennessee Bank in 2001. And throughout this time, I had begun with a colleague of mine a sort of pseudo macro piece where I was just a really big junkie for reading all of the research and finding out what was really happening because it made me a better salesperson for my clients. I was on straight commission this whole time. I've been on straight commission basically my whole career. So I started taking these most interesting data points and putting them together into sort of a bottoms-up macro piece for portfolio managers that I was calling on for the firm. And the piece took off with my client base, and then I started to have other salespeople on the desk come over and say, hey, one of your clients forwarded it to somebody at my account. Can you share that with me? And it ended up being a very widely read piece every Friday on Wall Street amongst institutional money managers. Fast forward to 2006, a group of partners, myself included, left and formed another institutional equity research firm. Again, reprised my role in sales, reprised my role putting together this macro thematic bottoms-up sort of data point macro piece. And into the great financial crisis in '08, and then after, was able to help a lot of clients that I called on for the firm position well ahead of '08 and then after '08. And then was spending more and more of my time in the aftermath of '08 on macro and Fed and policy type stuff, simply because, again, I was still on straight commission. And what I was seeing was that, unlike pre-'08, our bottoms-up fundamental research of what was going on was not driving the stocks the way it had, because monetary policy, Fed, central planning had really started to become a bigger driver. Fast forward 5 years, I decided I wanted to spend all my time doing this macro thing. Went to my partners, said I'd love to do something like this if we could create a seat, because we were really known for bottoms-up fundamental research. We'd built 15, 20-year brand doing this. And they said, yeah, we'd love to have you do that. And I said, there's just one caveat. I want to have complete creative control to write whatever I want to write, because I felt like that was going to be important increasingly in the coming years. Because I just got this sense that sort of the weird things that had never happened before that had begun happening with increasing frequency into and after '08 were probably going to continue. And so we parted ways amicably. I still talk to a lot of those guys. They still do great work there. And I hung out my own shingle as FFTT, which stands for Forest for the Trees. And what I do is I aggregate a large amount of publicly available data in a unique manner, trying to identify developing macro economic and thematic bottlenecks in various sectors of the global economy for my clients who are sophisticated institutions, family offices, and individuals around the world. So it's practically speaking, I read a lot and I do a lot of dot connecting, which I've developed or been given some sort of, a God-given talent for doing that. So I get to do what I love every day for hours a day. So I'm very blessed.
Yeah, your reputation is being one of the best in the business in trying to understand and put together a picture of what are very, very complex macroeconomic events. And so you noticed in 2007, 2008, that the Federal Reserve was behaving differently than it had historically. Tell me about some of those early signs and how that changed the way you began to model economic predictors.
Yeah, so really, and this was when I was still in my former seat, prior to 2008, we would get these data points and we would see the industrial distribution sector is slowing, or private credit card receivable charge-offs or debt collectors. We're seeing collectible or receivables extend, right? People weren't paying their bills. And when we would see a negative data point like that in the sort of the macro economy bubbling that up across different sectors, prior to 2008, those data points were leading indicators of what you would expect to see in a free market, which is to say the economy is getting weaker. If the economy is getting weaker, then that means growth is going to slow, inflation is going to get lower, there was a deflationary pressure. That should be bad for equity indices, broadly speaking. That should be good for long duration bonds, treasuries especially. And those relationships were very clear. You could graph, we could graph the aggregate of, in fact, we did graph at the time, the aggregate of all of our research data points and whether they were getting better, worse, a diffusion survey, basically like the ISM. And then we would chart that against the S&P 500 with just a very modest lag. We charted against the 10-year Treasury yield with a very modest lag. And it worked. It was very predictable up until 2008. And then after 2008, when the Fed started getting involved into 2009, something really interesting happened, which was the relationship inverted. In other words, we would see things get increasingly negative, and instead of what you would expect to see in a free market system, stocks down on a slight lag, yields down on a slight lag, as had sort of been the rule for the prior at least 20, 30 years, the opposite happened because markets were beginning to realize weaker GDP growth post '08 would mean more likelihood of more Fed QE for longer, more QE2, et cetera. And so instead of weaker data leading to weaker stocks, lower yields, we were getting weaker data leading to higher yields and higher stocks on expectation of sort of more monetary heroin, if you will. And the relationship change was very, very clear. And it was very, very clear in terms of the delineation. It was short. It basically began in 2009, and then it got reinforced really in the late part of 2010. Because in 2009 into 2010, there was still the belief, well, this is just a one-time thing. And then in August of 2010, when Bernanke kind of sneak previewed QE2, that's, I think, when everything changed, where it suddenly markets began to price in that we had entered a new era of central bank activism, I guess, is probably a good way to determine it. So I began seeing that. That was really that inversion of that relationship around 2009, 2010, that I had seen rule for my entire career, 95 to 2009 to 2010. Up to that point, started to invert. And again, being on straight commission, you're not dogmatic about it. If you are wrong a lot on straight commission, you starve. So once I started seeing this relationship change, being on straight commission, I, like a lot of other market participants, began to adapt. Okay, if this is how it is, now bad used to be bad, but now bad is good. Go.
You used a term I hadn't heard before, market heroin. You know, I think what you're indicating is that what happened in 2009 inverted things where things typically you would think would be bad signs for the economy became good signs because of interventions being taken by the central bank and the Federal Reserve. And here we are today in 2024, and it's much the same. We're still stuck on that market heroin. So we're an economy that is not very healthy, that's reliant on something artificial to make us feel good. Where do we go from here? I mean, this is clearly unsustainable. We know that you can't invert poor market signs into something positive forever. So what happens next?
It's a great question. To answer that question, I think you have to go back in time just to look at the path of how we got here, because I think once you can kind of see the path we're on, you can sort of extrapolate that forward and say, if we stay on this path, don't be surprised if we arrive at our destination. So in 2000, we had stock market bubble, it burst, and there were very great concerns. We're going to have a new Great Depression, a sustained period of underperforming economic activity, etc. And we would have. If you go back in time to 2002, you can read a piece in the New York Times, it's still up on the internet, by Paul Krugman, in which he and Paul McCulley's work, saying that we need to create a housing bubble in order to offset the lost consumer spending impulse, asset inflation, consumer spending impulse, from the decline in equity prices. And I have no way of knowing this. I was not in policy, but we can see very clearly credit standards were eased over the next 5 years for housing. Everyone kind of said, this is great. So they got their housing bubble. And the housing bubble did exactly. Now, to Krugman's credit, to Macaulay's credit, in a vacuum, they were exactly right. If you do goose and create a housing bubble, it will create or offset the lost consumer spending impulse from the decline in stock prices. So, as I've always said, what we did is we had a stock bubble, it burst, we kicked the problem upstairs to the housing market rather than taking our pain. It was a policy choice. Then we have a housing bubble that burst, of course. And famously, and when it burst, once again, we found ourselves with a choice, this time a much bigger, painful, problematic choice, which is, do we take our pain or do we try to kick the problem upstairs? And taking the pain there in a capitalist system looks like bank equities involved that are hurt, they go to zero. The equity gets wiped out. A lot of the money that was very influential in Washington policy, the Robert Rubins, the Larry Summers, etc. of the world, their equity goes to zero. Mm-hmm. The bondholders in a capitalist system of those banks should have taken control of those banks. So you wipe out the equity to zero, you fire the managements, the bondholders take over the banks, and then you restructure them and you move on. and it would have been extremely painful, but we would have been in a much more normal recovery within a couple years after that. There was a great article written by two former chief economists of the IMF, Simon Johnson, Miles Kwok and Johnson. I think it's Simon Kwok and Miles Kwok and Simon Johnson. Anyway, Johnson and Kwok, I know are the last names. In early 2009, in the Atlantic magazine called The Quiet Coup. And what it detailed was that rather than dealing with 2008, 2009 like a capitalist society, we dealt with it like a lot of the emerging market oligarchies that these IMF economists had been used to dealing with for 30 years. And the article is basically a cautionary tale. We are dealing with this the way these highly inflationary, dysfunctionally political, emerging market autocracies and non-democratic societies deal with banking crises. And if we don't change our course, we will end up where they are at some point. We have more rope because we're America and a tradition of free markets and the global reserve currency and so on. But it will ultimately be a problem. The Quiet Coup was a reference to basically Wall Street and banking sector lobby power to not have to take the pain they should have taken under a capitalist system. So once again, 2000, stock market bubble, crashes, we don't take we paper over it, we kick the problem upstairs to a housing market. Housing bubble, crashes, pops, instead of taking the pain, we kick it upstairs to the sovereign debt level. Instead of taking the pain, the resources of the U.S. federal government and more broadly speaking, Western governments around the world were brought to bear. Basically, the bad debt was transferred from the banking system to the sovereign debt level. And that's where we've been for the last 10 years. And that was partly why, when you go back to before, they had to keep doing QE. Because now the stakes, this is for all the marbles. You can't have a sustained recession. You can't have a free market deflationary period without it calling into question the solvency of a government, of the United States government. Now, of course, the United States government can't be insolvent. They can print dollars. And that gives us the clue to these last 5 years where, again, we had the COVID crisis. We did the same thing. We turbocharged it. We already had kicked a problem upstairs to the sovereign debt level. We have kicked COVID and the related debt upstairs on top of that as well. And so that brings us to today in terms of, okay, where are we and where are our paths forward? And the paths forward are crystal clear. There's really only three paths forward. There is productivity miracle, where we get sort of a rollout of AI or widespread adoption and of nuclear fusion or small modular nuclear reactors commercialized on a Manhattan Project scale type or type of time scale. That's option one. That's kind of the happy option, and that allows energy costs and it allows the debt to basically float. You know, the productivity growth will allow you to de-lever your balance sheet, the sovereign balance sheet, without hurting the value of the debt. That's the happy outcome. That, at this point, is somewhere between a fairy tale and a unicorn, barring some sort of classified thing I don't know about. The other two options are essentially print or default. At this point, we've kicked the problem from the stock market to the housing market to the sovereign debt market. There's nothing above the sovereign debt market. The only thing you can kick it to is either Mars, right? Like maybe the Martians will come down and we can put our problem on their balance sheet, or the currency. They print the money. That's it. And that's really it. Is if you look back in time over the last 120, 200 years, Reinhardt and Rogoff did a great study called "It's Different" or "It's Never Different This Time." And a little bit tongue-in-cheek, but they look at sovereign debt crises going back 500 years. And what they found in the last 120 or 140 years in particular is very clear, which is that once sovereign debt to GDP gets to about 100, 120%, every time there's either inflation or in a few hyperinflations or restructuring. You start defaulting on parts of your debt on a nominal basis. And that is really where we are now as a society, we've started to see rumblings of it with the inflation over the last couple of years. Some of it was COVID related. The policymakers want to say it was all COVID related. It wasn't. Part of it were the early rumblings of, we have a fiscal and debt problem, and it's getting acute in the United States specifically, in the G7, the Western G7 more broadly. And it's really that decision is do we want to, we're going to have a nominal default. In other words, boomers, we're cutting your entitlements by 30 to 35% immediately and permanently. We're going to cut defense spending by 30 to 35% immediately and permanently. We're going to, or because really that's one of the, there's only three things that they can cut that are big enough to cut: entitlements, Social Security, Medicare, Medicaid, defense, or interest expense. By far, those three things are about 120% of tax receipts right now. So they can cut entitlements and defense immediately, permanently, or they can cut interest expense immediately, permanently. And the only way you do that is by defaulting on the debt or cutting rates to zero. Defaulting on the debt is deflationary. It's not going to happen. Cutting rates is inflationary. And there's a number of different ways they can cut rates, but that is really where we are, which is because we have kicked the problem from the stock market bubble to the housing to the sovereign debt level. Failing a productivity miracle, we are now into print. We're going to default nominally, probably not, or we're going to default on a real basis, which is print money, negative real interest rates, sustained high inflation for a period of time.
Yeah. The productivity option, you said it was somewhere between a unicorn and a, I can't remember the other one, but it's a Hail Mary, right?
It's a Hail Mary.
It's a big Hail Mary. And, we see signs of the government trying to make this Hail Mary, with the CHIPS Act and, pushing for innovation across various sectors, including healthcare. That's a strange one because on one hand, we spend so much government dollars on healthcare, but on the other hand, it's one of our most profitable industries in the United States. I talk to wealth managers quite frequently, and they oftentimes talk about, well, maybe biomedicine and biotech is our Hail Mary. What are your feelings about that?
So the challenge of the debt level and the deficit level, and then also the off-balance sheet liabilities that are Social Security, Medicare, Medicaid, right? That's $50, $100 trillion, whatever it is, coming on balance sheet by virtue of demographics because we waited too long to deal with this issue. The challenge with that is that it narrows the window. So yes, we could do biomedicine. However, the debt is so high, which means the leverage to movements in the economy is so high. Our productivity, we not only need a productivity miracle, we need the productivity miracle to arrive in Goldilocks-like fashion, right? If it arrives too fast, I want to say healthcare sector in total is, I think last time I checked, like high teens percent of GDP, 17, 18% of GDP. And it's low productivity, so it's probably about that of employment too, right? So if we get a sort of a productivity miracle in healthcare, it's a two-edged sword. Your costs are going to drop, but your unemployment's also going to drop. And so that is okay in a federal debt to GDP. It's okay if unemployment goes up a lot in healthcare in a world where U.S. debt to GDP is 60%, not 120%. And deficits are 2-3%, like they were not that long ago, not 7% with unemployment at 3.5%, which is a staggering number. Because if we start to have a spike in unemployment in healthcare as a result of a productivity miracle arriving too fast, then any cost decline you're going to get on the productivity miracle is going to be offset by the counter-cyclical payments as all of a sudden your tax receipts from the healthcare industry plummet and your unemployment benefits rise, and you those two things, and again, in a 60% economy,
it doesn't really
there's
work.
not as much downside leverage to that unemployment where there is now. So you might actually get a productivity miracle if it arrives too fast and end up with a deficit worse than that. And we have an empirical example of this in lower in a case of lower debt. So if we go back to 2014, the Wall Street Journal, late 2014, said Obamacare is going to lower the U.S. government's cost of healthcare by pushing the cost onto consumers, and that will help reduce the deficit. And going into 2015, so far so good. The challenge was when you go from pushing something that nobody basically pays for, basically, right? It was nobody. The government was just adding it to the tab and rolling it. To pushing it down to actual people, my Obamacare premiums went up 30%. And I had to pay that. Previously, that was just being added to the U.S. government's tab as a deficit and then debt. When I had to pay it, and when lots of middle America had to pay numbers like that, they don't go out to eat as much. They don't buy they buy one less Christmas gift. They don't get a new car that they might. Point is you start crowding out the U.S. consumer to pay for their own health care, which probably makes sense in the long run. But the challenge is doing that. By 2016, the U.S. deficit as a percent of GDP was actually higher than it was in 2014 after taking a long-term sensible step to lower the U.S. government's deficits by pushing part of their biggest cost onto U.S. consumers. And that was with debt to GDP more like 80, 90%, not 120%. So that gets into this challenge of the time to have been doing this kind of thing would have been in the 90s. In the early 2000s, when we were running surpluses or close to it, the deficit was tiny. The boomers had not started retiring at 10,000 per day. We hadn't spent $8 trillion of borrowed money doing ill-advised things in the Middle East and getting little to no return for it, really a negative return in a lot of ways. So if you get that productivity miracle too fast, you might end up with a deficit higher as a result of the unemployment, the initial unemployment. Long run, you'll be okay. But when your debt is this high, there is no long run. There's no such thing as the long run.
Yeah.
And similarly, if it doesn't arrive fast enough, that puts us right back into sort of the first situation we ran through earlier, which is doesn't run fast enough, we're going to have the debt deficit spiral problem that we've started to see rumblings of.
Yeah. So then, it really next begs the question about healthcare spending is not a solution to the economy. It seems like it just leads us further into deficit. So, investments into a miracle cancer cure really aren't within the context of a Hail Mary. It's really just puts us into further deficit. And that doesn't even account for the productivity losses from people getting sick in this country. And just the incredibly high numbers of chronic disease, especially amongst our children, the rapidly increasing rates of cancer. So healthcare spending looks like it's going way up, and we're taking people out of productivity as a result. Is this, one of the biggest focuses of Bobby's campaign is trying to solve for chronic disease, and it's more than just solving for chronic disease when you actually think about the economic impact of our how taxing this is across the economy. What are your thoughts on that? If you have any additional insights into forecasting increases in healthcare spending due to chronic disease?
Yeah, if you increase, and that's been one of the problems, is around 2011 or so, the first phase of entitlement payments in the U.S. basically started going cash flow negative. We knew about them forever. 70 million boomers were born from 46 to 64. stands to reason, sort of any actuary with a calculator and a sixth grade math education knew they were eventually going to be 65. And so what started out as a really good idea in terms of these entitlements in Medicare, Medicaid, Social Security, because we have to go back in time, late 60s when LBJ put these in place, being old was akin to being poor. I mean, if you were old, unless you were a very tiny minority, you were poor. You were very poor. And so this made a lot of sense. You were a small generation. You had fought in World War I, Korea, World War II, Korea, etc. That made sense. Where it started to not make sense and where something needed to be done, where some political courage needed to happen, was in the 90s, when you could see very clearly, and even in the 2000s, we were shifting in toward this moment where our entitlement bill was going from cash flow positive. In other words, we were taking in more money to pay for these things than we were dispersing. Everyone knew this moment was looming. Everyone could see that the boomers were quickly becoming the wealthiest generation in the history of mankind. And yet they were also set to receive all these benefits. And it just has obviously always been a political third rail that no one can touch. And I get that. And it is what it is. It's human nature. It's a tragedy of the commons. It's nobody's fault and it's everybody's fault. And so here we are. And now these are running cash flow negative. We do have this epidemic of chronic disease that is, if anything, getting worse. The way you get out of this is, if we assume a Hail Mary is not going to happen on productivity and we know we're not going to default on the debt, then the way you get out of this is a sustained period of negative real interest rates. In other words, basically the Fed caps interest rates at 2 or 3%. And inflation runs hotter, and everybody's money declines in value, in purchasing power. The challenge of these entitlements in light of that, which is quickly becoming the most likely outcome just by virtue of the other two are basically tail options increasingly and thin tail options increasingly, is that the United States does not owe the baby boomers their entitlements in dollars. We frequently hear economists say, well, we're fine. Our debt situation, our fiscal situation is fine because we owe it all in dollars and we can print dollars. And so, the release valve will ultimately be inflation, but so what? And that's true for the $34 trillion of debt that we hold. But for the somewhere between $50 and $100 trillion of off-balance sheet entitlement liabilities, and off-balance sheet for a non-financial listener means that's not in that $34 trillion debt number, but it is effectively a piece of debt. We owe a payment to somebody in the future. So that $50 to $100 trillion off-balance sheet liability is actually inflation adjusting. We owe Social Security. There's a cost of living adjustment. Just 2 years ago, it was an 8% COLA increase. So that number goes up, and that's a number the government can fudge. They can say CPI is 4, and it's actually 6, and so the COLA is 4. Right? That you can manage a little bit. The more challenging part is the Medicare-Medicaid dynamic in all of this, because we do not owe U.S. baby boomers, etc., dollars under Medicare-Medicaid. We owe them HIPs and doctors' time and pharmaceuticals and hospital beds, etc. These are no different than owing debt or a liability in a foreign currency that we cannot print. We can't print HIPs. We can't print doctors. We can't print hospital beds. And so the more we do print for other things, the more the price of the HIPs and drugs and docs and etc. are going to go up, because you can't get around economic law, which is that over time, the more finite good will go up if you print money to buy it. That then gets us into this very dangerous territory that is not that different mechanically than an emerging market that owes has offshore dollar debt and they start printing their local currency to try to keep the economy going, leading their currency to fall, but they still owe the dollar debt. And so they print more, and the inflation picks up, so they have to print more. And we're in kind of an early stage side of that game, but that is a real challenge for this portion of of our obligations. I mean, the sort of happy outcome is you sort of can manage it, and it doesn't go critical in terms of the inflationary impact, where you're basically like hyperinflating your costs, and kind of try to manage through the boomer generation. And then, my age, I'm not expecting much from the federal government. I'm certainly not expecting the purchasing power of what I get from the federal government to do much for me in terms of Social Security and Medicare, Medicaid, and I'm investing accordingly. Point being is that I think there's a lot of people, particularly if you means test, where you say, look, after the boomers, we're going to make this adjustment. That's something you could do. It's going to be politically unpopular, but at some point, either politicians and policymakers do it, or the market's going to do it for you, which is to say, you're just going to hyperinflate your costs of healthcare, and then the people can afford it, and the people who can't. And that then gets you into very dangerous political territory in terms of the stability of the country.
Yeah. So one of the things that I've been trying to look at, and I'd love your take on it, is efficiency within the government. I mean, we have a massive budget. The Government Accountability Office, which really oversees spending of the agencies, what are your opinions on how they're operating, and how do we modernize the practices of the GAO?
Well, I don't know. I'm not familiar with how they do things, other than I look at their numbers. I look at the CBO in particular and some of their numbers, and to me, I think we need to take a step back on a first principles basis, and as a government and as a country, and basically stop believing kind of the collective lies that we tell ourselves, sort of the comforting lies as opposed to the inconvenient truths. So we've had a couple examples of this. In recent years, right? Sort of, Russia will be easy to tip over if we look from a geopolitical standpoint. Let's help the Ukrainians. That war will be easy. It will be cheap. We'll get Putin out easy. And here we are 2 years later. It's not going that well.
No.
The Russians are outproducing us in a lot of ways because we thought our GDP of 27 trillion was 10 times the size of theirs, except a lot of our GDP is like flipping houses and financialized, and theirs is actually making stuff. Foreign and trade policy of the last 20 years is a perfect example. Afghanistan was named its nickname's the graveyard of empires. And some very great nations have gone in there and come out significantly financially weakened. And like 2002, as awful a tragedy as 9/11 was, I don't want to minimize that. There are steps we could have taken that were commensurate responses,
right,
and move on. And instead, we were convinced, our policymakers were convinced, we're America, the graveyard of empires won't apply to us. Well, it's starting to look like it might again, based on where our fiscal situation is at. So that's what I mean about these sort of inconvenient truths or these comforting lies. Yeah. Let's take a step back and say, okay, here's what happened over the last 20 years. We did have a stock bubble, should have taken our pain. We kicked it upstairs. We didn't. We should have managed the banking crisis the way everybody else had to manage their banking crises. And oh, by the way, the IMF forced it on them, and we were basically the hand in the glove, telling the IMF what to do, puppeting the IMF to do those things, and we didn't do it ourselves. Now here we are with the sovereign problem, and there's sort of this giant comforting lie being told, which is like what Dick Cheney said in '04. Well, Reagan proved that deficits don't matter. And in '04, that was true. In Reagan's time, that was true. It's not true anymore. And the markets are telling us every day, there's virtually every day a signal that deficits do matter again. The debt does matter. And we do need to start thinking about, not even think about, we are well past needing to think about. We need to start taking actions on some difficult choices. And so that's when I say we have to stop pretending. Like, that's the biggest one, is the debt does matter. The deficit does matter. It matters now, and it's going to matter more tomorrow and more the day after that. And every day we pretend that it doesn't matter, and the GAO says, well, it'll be a problem in 2030. It's not going to be a problem in 2030. It's going to be a problem. It is a problem now.
It is a problem now. We're seeing it. We're feeling it in housing, cost of living. It's already happening, and it looks like the dam is breaking, and we're trying to keep it from flooding us. And we do have some tools at our disposal. And it sounds like what you're saying is the only way out of this is we got to go through it.
Yeah, for me, I'm actually really encouraged. I think my kids are going to be, I think they're going to be adults in sort of a new golden age. I like to think of the 80s and the 90s and even the early 2000s as kind of a golden age. Mm-hmm. I think they're going to be in another golden age. So people ask, hey, aren't you worried about your kids? And I had a conversation with a friend recently where he asked me that question. I said, remember when our boys were born? So my son was born, my oldest son was born 6 weeks before 9/11. And I was laughing with my wife. I said, do you remember what that was like? Summer of '01? It was like we had no worries. Everything was great. Everything was good. The music was bubblegum all the time, and boy bands, and we were running surpluses, and like our biggest crisis in the past 5 years had been Bill Clinton lying about the Monica Lewinsky scandal. Like it was laughable. And I said, we had kids into that. It was like, oh, it's going to be great. And then like 6 weeks later, kicked off sort of 20 years of just, my goodness, now what? Oh, now what? Oh, now we have a housing crisis. Now it was been one thing. And so I'm actually really encouraged that by the time my boys are all, I mean, they're young adults now, but by the time they are adults with family of their own, my grandkids, hopefully someday, not yet, boys, someday, I think we're going to be another golden age. But to your point, the only way is through. And I do worry a lot. I think the next 4 to 6 years are going to be very bumpy. And I think it's really just a question of how bumpy. They could be really, really bumpy. They can be just a lot bumpy. But I think it's going to be bumpy, and I think it's going to be a pivotal moment in American history, sort of right on schedule with sort of this fourth turning ethos that we've all heard of over the last 25 years. It's arriving right on time, and I think it's right. I think the next 4 to 6 years are going to be pretty bumpy.
Let's talk about taxes. Big political issue. What are your thoughts on, there's quite a few economists that have said if we reduce taxes, spending goes into the economy, it stimulates the economy. Government's not the best party to be spending it. And if they're spending it overseas, it's certainly not helping us at home. What are your thoughts on like, what's the most apolitical tax policy you could think of that's in the best interest of the American public?
Here's another one of these instances, I think, where the economists need to stop lying to themselves or start looking. They need to start, and they're not lying to themselves. Most of them really aren't. Most of them are just not seeing things for what they are, right? Wisdom is seeing things for what they are. The United States, the sort of, supply side tax cut dynamic that, the playbook we've been running since like 82 or whatever, right? Since Reagan, that is a policy that drives a certain outcome when you have a low debt to GDP. Makes a lot of sense. When the federal government is running 120% debt to GDP and 7% deficits at full employment, because of us kicking the problems upstairs for too long, bad foreign policy, lack of political courage to restructure these entitlement bump, we knew it was coming. Now, if you cut taxes, all you're going to do is increase the deficit further. The deficit's like increasing the deficit isn't the problem. The deficit is the problem. And so it's the wrong medicine given where we are in the economy. It's like telling a 500-pound, 80-year-old lifelong smoker, like, hey, get on a treadmill and join CrossFit. You're like, no, that's not the right solution. You gotta, if you're going to do that, you gotta get the debt to GDP down first. Because if you do supply side stimulus like that, all you're doing is effectively, you are injecting more dollars into the economy, but now all that does is destabilize the U.S. Treasury market. And by destabilizing the U.S. Treasury market, which is already increasingly dysfunctional, increasingly frequently, you're going to send rates up and you're going to end up worse off than you were because the U.S. government debt load is so high. So there has to be an order of operations, in my view, around tax policy of you got to get debt to GDP down to a level low enough such that anything else you do doesn't blow up the Treasury market first. We're seeing this now with the Fed having hiked rates so aggressively to fight inflation. Inflation's picking back up. Well, it makes sense. Like, you've got $34 trillion in debt out there. And you just increase the amount of interest you're paying on it. And so, yes, it was disinflationary for a second, but now deficits are picking back up tied to interest expense. So I think around taxes, you got to get that to GDP down first by virtue of some period of negative real rates or there's a number of things you can do to get, basically inflate some of that debt away. And then you can start looking into some of these other policies. But again, it's that leverage, right? Where if you start, the debt to GDP is so high, the leverage is so great on any little move you make to policy. And when the debt's that high, it's almost always to your detriment.
Yeah. Yeah. So what I'm hearing is there's an order to operations out of this, right? And if you are a policymaker or selling something to the American public, the only responsible package you can sell right now is, reduce spending, first and foremost, work on productivity gains wherever possible. That's in the best long-term interest of the American public. And we've got to get GDP to debt balanced as quickly as possible. And if you're selling anything else, that's just clearly for votes, it seems then, correct?
It probably is. And it's, and importantly, shrinking spending, it has to have an asterisk by it because if you shrink entitlements and defense, there's going to be a negative multiplier to that reduction in spending because we've let U.S. government GDP get to 25% of GDP, right? So right now we're running a roughly 7% of U.S. GDP federal fiscal deficit with unemployment at 3.5%, unprecedented other than COVID and to a minor extent in 1968. We all know what the 70s looked like inflationary-wise when LBJ was doing guns and butter. So let's say at 7% fiscal deficit to GDP, let's say we just want to get back to 3% deficit to GDP. So we would need to cut 4% of GDP, roughly $1 trillion, a little over $1 trillion, $1.1 trillion, out of government spending now and permanently. This creates a version of the Obamacare problem I highlighted before, which is to say, you're going to take 4 points of GDP away now on the promise of a better fiscal situation in an undetermined future. It's a responsible thing to do, but because we have the high debt to GDP, we don't have the luxury of waiting for that benefit to arrive, because the reality is US GDP fell 3%, 3 or 4% annualized over the full year of the great financial crisis. And we know the entire system almost collapsed. The banking system, the economic system, the global economy. So now you're talking about taking 4 points of GDP out instantly with debt to GDP higher, almost 50% higher. It was 80% or so then. It's now 120% of GDP higher. So you're not going to be able to, the economy isn't going to live long enough to get the benefits. You take those 4 points out of entitlements or defense, mathematically, you're going to put the economy into a recession that is worse than the great financial crisis with more leverage. So the downward spiral will just happen faster. That's like the one outcome of why I say you have to put an asterisk by reducing government spending. The other side of it is cut rates to zero, reduce the interest and have basically the Fed and Treasury term out the debt, not even term out the debt, bring the debt in, do it all in T-bills, and the Fed buys it all. And now you're not going to have any interest expense. You can take interest expense to zero, basically, for a period of time, and the release valve is going to be the international trade value of the dollar. You're going to see inflation that will be probably an order of magnitude worse than what we had 2 years ago at peak. Now, in the intermediate term, that is a super good outcome for America. That will actually, as painful as, and that's to me like the bumpy but good outcome, that's kind of a version of it, second only to sort of the happy Hail Mary productivity. Because what that does is ultimately, just by virtue of where we are, you're going to see the groups that lost over the last 40 years of economic and trade policy, the middle and the working classes, you're going to see their wages rise faster than those of the 1% financialized classes. And you're essentially going to be having the boomers pay for a lot of their own care by virtue of the real depreciation of their bond portfolios. So the boomers will end up basically paying for their own health care because their bond portfolios, real value in healthcare terms, et cetera, will fall quite a bit with the inflation. That's actually kind of a fair, it's actually in a lot of ways a politically, it checks a lot of boxes in terms of a lot of politically desirable outcomes. Hey, are you in favor of a more balanced wealth and income in America? Yes. Okay, this will do that. Are you in favor of some sort of tax increase on the wealthiest generation in America to pay a little bit more for their own health care, particularly those with the most assets? Everybody says yes. And then you go, hey, it's because inflation is 15% and the Fed's capping yields and financing the deficits for 3 years in the T-bill market. And everyone will go, no. And
well, let's talk about that no piece, because let's think about who's making the most off of these interest payments right now. Like, what's the reality of that? I mean, I see it in my own portfolio, and I think that drives a lot of the frustration around inequality in this country at the household income level. Would love to, hear your opinions on really who feels that if we drop interest rates to zero.
Bondholders do. and the bondholders, to your point, the Federal Reserve database, they have FRED database. One of the data series they have is the total assets held by the 1% of Americans. And that number, I looked at it a couple weeks ago, it is roughly $45 or $47 trillion. And it also has a a chart, a line item, a data series for the and dollar value of assets held by the bottom 50% of Americans, and it's like $3 or $4 trillion. And so the people going no are the asset holders, the bond holders, the asset holders, the 1%. And then also there is a very big foreign policy / economic policy school that sees the treasury market less as an asset to be held and earned an income from and more as a collateral / international reserve asset / instrument of American power. And so you would have obvious squawking from the class holding it as a wealth asset and an income deriving asset. You less obvious, but perhaps more loud and more politically powerful would be the class that still sees the treasury market as an instrument of American foreign policy, power, etc., even though it isn't anymore, by the way. But,
Yeah.
there's a group of, sort of, if you go back and you look at a quorum of the Treasury secretaries and Fed governors over the last 25 to 30 years and start pulling names and putting them up there, those people who are politically connected, tied in, they would be very vocal in working the channels of power that doing this would be a bad idea because it would hurt American power. Now, the reality is that they're wrong. They're dead wrong because the dollar system, as it worked for them, it has changed. Our debt is high, deficit is high, and it is being weaponized. The dollar system as structured from 80 to 2018, 2020, I would argue, has been and continues to be weaponized against us by our adversaries. So like they're fighting, they say generals always fight the last war. They're fighting the last war. But those would be your two constituencies that would say no.
Yeah. Let's talk about that second one, because I've been following BRICS. Really fascinating how it's grown. Really fascinating who's a member of it, how they work together, and how they construct economic policy together. A lot of these are these planned economies, but they also really focus on productivity gains, a lot of these countries. It's more than just an economic allyship. There's, vast geopolitical strengths that they're amassing from it as well. What are your feelings about BRICS as it relates to our positioning and fiscal policy? And like, I think that will help everyone understand and define why, making these adjustments to interest rates really are in our best interest given current geopolitical alignments.
So I'll take it from a purely factual basis to start, and then kind of summarize with a conceptually kind of where it is and where it, us versus them, right? So they've got lower debt to GDP by far in aggregate because a lot of them went through what we're going through now about 20 to 30 years ago. They've got lower deficits by virtue of how the existing dollar system works. They can't run big twin deficits. They have to run current account surpluses. Most of them do. They are in aggregate the majority, and BRICS, I'm going to throw Eurasia in there broadly, but they are the majority of global oil and commodity production and reserves. They are the factory of the world in aggregate, led by China, as well as accelerating in a major way Southeast Asia, even India a bit. They're about 40% of global population. They are in aggregate major creditors, sovereign creditors of the United States. They are the majority of global GDP. They are by far the majority of global GDP growth. They have vastly lower per capita consumption of critical commodities than we do in America. So, for example, Chinese, even in 2021, China is already the world's biggest oil importer. They're bigger than us, and they have been for half a decade or more. They still only use 1/5 the oil per capita that we do. The Indians use 1/15 the oil per capita that we do, which is critical because both of their populations are 4 times our size. And that suggests if I'm Saudi Arabia and I'm looking at China and India rapidly gaining income growth, moving up the value chain, and I see their oil per capita consumption is still a tiny fraction of America's, that's 2.8 billion people whose per capita oil consumption is going to increase, full stop. Climate, all the other stuff, it's noise. It's going to increase. It's going to increase a lot. And that starts to impact alignments. If I'm Saudi, if I'm Russia, there is no question where the next 20 years demand growth is coming from. It's going to come from the BRICS. It's going to come from Eurasia. They're rapidly moving up the value chain. A lot of people still think of China as sort of making cheap plastic trinkets for Walmart, which is a wildly naive and out-of-date view when you start looking at what they have done in space with satellites, down to what they have done in terms of Huawei phones relative to the latest Apple stuff,
chips,
etc.
photovoltaics,
It's
battery
all of it.
technology. Yeah.
Yeah, so I would say their position relative to the West is far better than it's far better, period. And it's certainly far better than the mainstream narrative regarding the BRICS position relative to the West is.
So, so this idea that we can't reduce interest rates because of economic positioning is almost irrelevant given, the facts of the matter, which are that, these countries are heavily producing, they're innovating. They've figured out their economic policy. They went through those hard times, um, and and they've made it through, and they're on the other side of it. So the example then should be for us. We can go through this. It will take, 4 years, hopefully less. But the sooner we get to it, the better. And it shouldn't impact our relative positioning geopolitically because, America remains a very powerful nation. And I think that's the reminder that we all have to get back to is that we are a very, very powerful nation. We have a beautiful country. We have some of the smartest, most innovative people living here. And it's just a matter of going through this economic adjustment so that we can get back to the business of harnessing that incredible innovation here.
Yeah, there is absolutely. We need to get back to playing to our strengths. And there are encouragingly elements of the U.S. policymaking class that have been aware of this for a long time. So in 2011, Chairman of the Joint Chiefs of Staff, Admiral Michael Mullen, said the biggest threat to America is not terrorism, it's not climate change, it's not it's our debt. It's our debt. We are borrowing, and he said this, his quote, "We are borrowing money from China to build weapons to face down China. This is not a sustainable strategy." And I would include now increasingly using Chinese components to build those weapons. And it's really not a sustainable strategy in that way. And so that was still a very minority view of the world up until I would say when Trump got elected. And when Trump got elected, he started in a very bull in a china shop way, pointing these things out. And the military, there's a very good, it's a publicly available version of it, unclassified version. It's called Assessing and America's Defense Industrial Base Strength, basically. It was 2018. And it's basically, the public version at least, 130 pages, chapter and verse, the various parts of the U.S. Defense Industrial Base and how much of it is either single or dual sourced from China by virtue, and this is the part that most of Washington did not start to get until 2020. The reason that is the case is the dollar system as it has been structured since 1971 and especially since 1980. Our biggest export is treasury bonds by far. The world makes stuff. They send it to us. We send them dollars. They send us the dollars back. We send them back treasury bonds and US financial assets. That works great early on. It's very stimulative. It's very good for consumer growth. It's terrible for the middle class. It's terrible for the working class because we offshore the factories to help run the deficits, etc. This is the economic era post 1980. There's something called Triffin's dilemma that you can, I'm sure you're familiar with it. Other people, you can look it up to listeners. Eventually, this system results in too great a degree of hollowing out of the U.S. defense industrial base, U.S. manufacturing base. It leads to our inability to produce what we need. It leads to a hollowing out of the middle and working classes that provide the political stability to any country. Your political stability comes from your middle and working classes, and if you kill them, your political stability fractures and you start to get extremist, which is, of course, is exactly what we've seen. To many people's surprise over the last 10 years, it has. If you understand this dynamic, it shouldn't be surprising to you, and it tells you it will get worse if we don't change something. So Triffin's dilemma results in the bankruptcy of the reserve currency issuer if that reserve currency issuer uses its own debt to settle its trade deficits. And that's where we're getting. And so there's still this view in Washington that the global reserve currency structure of the dollar as it's been since 71 is a good thing for America. It's not anymore. It hasn't been for at least 10 years. Admiral Michael Mullen knew it 15 years ago. The military knew it 15 years ago. But what it took to actually open the eyes of a lot of people in Washington, because Washington loves it, right? If you're, if it's great for the issuers of treasuries, there's nobody bigger issuer in treasuries. There's nobody pushing treasuries more than Washington. This is deficit without tears. What really opened the eyes to a lot of people in Washington was COVID, because now all of a sudden it's like, I need a mask, I need PPE, and my grandkids need a mask and PPE. And it's like, sorry, we don't make that. You got to call China. 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 What else do we got to call China for? Well, pretty much everything. We can't, and it's not that they make everything, but we can't make anything ourselves without components from China. And in a highly globalized system, if you can't make one thing, you can't make anything. If you don't have one component, you can't make anything. So COVID, in a lot of ways, opened the eyes of Washington to the Triffin's dilemma, that the dollar system had hollowed out this system way too much. So what's the fix? Am I saying we should end the dollar's reserve status? No. I think the dollar is going to be reserve currency. I think it's a good thing. What you have to end is the treasury bond as the global reserve asset. That has to happen. And I think it has been happening globally. I think it got turbocharged in 2022 when we seized Russia's reserves, seized their treasuries. That then puts us back to a system that's a modified version of the pre-71 system. People forget, pre-71, the dollar was reserve currency, but the reserve asset was ultimately gold. If we shift from treasury bonds to a neutral reserve asset, like gold that floats in all currencies, or Bitcoin maybe someday, that ends the Triffin's dilemma, where dollar's still reserve currency, but now the dollar is going to fall dramatically in global trade markets based on our balance of payments. We're going to need to settle a lot of gold. We're going to need to ship a lot of gold, a lot of Bitcoin maybe someday to settle our trade deficits. And if we don't adjust the value of the dollar relative to the new neutral reserve asset, we're going to run out of it. And so as we do that, that does two things. Number one, that makes the middle and working classes competitive again, like they were from 46 to 71 before we closed the gold window, and then really ramped up using treasuries, not gold, to settle our deficits. And then number two, it's going to end our adversaries' ability to use mercantile policies to our detriment. And China in particular, people say, oh, well, China's doing this, China's doing that. China's just playing within the rules of the system. The rules of the system are China sends us stuff, we send them dollars, and then they can do whatever they want with that dollar because the current structure of the dollar reserve system is we have a completely open capital account. If we close that, that ends the dollar's reserve currency.
Mm-hmm.
So China comes in and says, you know what? I don't want to own those treasuries. They don't make any sense for all the debt reasons we said before. You know what I'll do? I'll buy Smithfield Foods. Chinese people eat a lot of pork. Great. I'm going to buy Smithfield Foods, America's biggest pork producer. I'm going to buy oil fields. I'm going to buy gold production. I'm going to buy copper. I'm going to buy, hey, is the port of New Jersey, New Jersey for sale? They tried to buy that 15 years ago or so, 10 years ago. That's the system. That's the dollar system. If you don't like what China's, and oh, by the way, they can also control our political system because they buy equities. Once you buy enough equities, again, in capitalism, if you own enough of the company, you get a growing say about what the company does. As America runs trade deficits with China under the current system and then recycles it into corporate America, and corporate America has a very big pull in Washington, and we all know the varying degrees of the lobbying that go on in Washington. China gets a greater say in corporate America, and they get a greater say in the policies of the United States.
And what happens as a result of that, which is the natural inclination to go in and buy natural resources. So China's buying up a ton of mines, access to natural resources, food supply. They're looking at America and trying to figure out, what to purchase within the best interest of China and the Chinese economy, which logical.
It's perfectly logical, and they're using it for diplomacy too, right? When you look at Belt and Road, it's a version of the Marshall Plan that we did back in the 40s and 50s in terms of rebuilding Europe. It's ascribed to being beneficent when we did it in the 40s and 50s, and sort of less beneficent in China's case. And I try to look at it agnostically. It's a perfectly logical, rational way to deal with the system as it is, which is America has a debt problem. It's unsustainable. We don't know when it's going to cease to be unsustainable, although it's looking more and more so per what we discussed earlier. But if that's the case, the last thing you do is lend more money to America. What you do is you take the dollars you get from America and you begin to buy up more finite assets, number one, like we were just saying. And then you also use it to win friends and influence others. So, Larry Summers said last year, that a senior policymaker at an emerging market told him what we get from the Americans is a lecture, what we get from the Chinese is an airport. And it's a little quip, and it's maybe a little flip, but it's directionally accurate. You can see them building this infrastructure around the world in terms of building long-term diplomatic ties, geopolitical influence, etc. And what underpins all of that is Chinese mercantilism, yes, but what underpins Chinese mercantilism is this structure of the dollar system since 1971, whereby we export dollars and then we recycle it into treasuries to finance government deficits. And if the government spends those things on things like wars in Afghanistan and Iraq and Syria instead of domestic infrastructure, healthcare, education, then you get what we've got here right now, which is over the long run, the Chinese have invested much more wisely than the American government has, full stop.
Yeah. So let's talk about gold. What are the mechanisms that lead us to moving from the US dollar as tender to gold? How do we get there?
So ultimately, there's a lot of ways you can get there. Mechanically, Treasury Secretary has a very wide latitude under the Exchange Stabilization Fund to do whatever she wants to do to manage the value of the dollar, the international value of the dollar. So that could include, it literally says they can buy gold if they want to. So in theory, she can borrow money and buy gold and drive the price of gold up. And ultimately, if gold got too high, people would get the message and realize, oh, and especially if it was leaked out that that the U.S. Treasury was buying gold, that everyone in the world is going to know what that means. The dollar, they want the dollar lower. They want to change the system to something with gold as a neutral reserve asset. Gold would get repriced significantly higher. As a practical matter, you would probably need to pull the Fed in at that point to monetize effectively. They hate that word, but that's what it is. Monetize treasury bonds, basically finance deficits for a time. And we would have much higher inflation for a time. Now, ultimately, the higher inflation you would drive asset prices higher. Negative real rates would drive inflation and asset prices higher. That would drive the deficit lower. The trade value, international trade value of the dollar would decline a lot. And you would probably see a very substantial increase in investment in America now that the Treasury Secretary was effectively declaring that the orthodoxy of the last 40 years is over. This system is off. This you send us stuff and we send you debt is over. It's really interesting. Janet Yellen said basically exactly that in the Wall Street Journal 2 weeks ago. There's an article titled Janet Yellen missed the first China shock. Can she stop the second? And in it, she followed on the heels of National Security Advisor Jake Sullivan, who said something very similar a year ago, and it was reprinted again in Political magazine earlier this year. Basically, that the economic and trade policies of the last 40 years no longer make sense for the United States, and we are aggressively working to restructure that system. So mechanically, that is how it could be done. There's other ways you can do it. It's really good for America in the intermediate term. Again, the bumpiness is a period of inflation and kind of getting through that. But
yeah,
there's a lot of go ahead.
In terms of inflation rates, so we've had rising inflation. I've heard economists talk about, the bumpiness of correcting our fiscal policy is going to possibly result in a kind of inflation that is going to be so startling and so catastrophic. What's like the reasonable range that we're looking at? And what's a realistic range, and how long do we have to carry that for?
In inflation, you mean?
Mm-hmm.
So in April of 2021, I wrote a report for clients. And I went back to the historical analog of right after World War II. So US debt to GDP in early 21 after COVID was up to around 120%, 130%. And so I said, okay, when was the last time that the GDP was this high? And it was in the immediate aftermath of World War II, when it was about 110%. And then I looked and saw how quickly were we able to delever. And what I found was that we went from 110% debt to GDP in 1946 to about 50% by 1951, at which point there was something called the Treasury-Fed Accord, where they basically said, we're not together anymore. We're not going to operate as a single unit. The Fed is now independent again of the Treasury. And so I said, okay, it took 5 years, and they reduced it by, call it 50, I think it was 55% debt to GDP, 110% to 55%. And so I carried that 55% forward, and I said, okay, I want to go from, I think 70 to 80% debt to GDP now was where debt to GDP was the last time the Fed was able to really act independently and raise rates and manage monetary policy
without creating treasury dysfunction or higher inflation or some of the things that we've seen them cause over the last 3 to 5 years. And so let's assume 70 to 80% is the target. We're at 125% now as of April 2021 when I wrote the report. And then I went back and I looked and I said, okay, how much has debt grown on a compound annual growth basis, on a compounded annual basis, and found that over the last 15 years, it had grown by about 8% CAGR, federal debt total. So I said, okay, federal debt total is still going to grow 8% CAGR. And we want to go from 125% to 75% debt to GDP over 5 years, like we did after World War II. What does that imply for the rate of negative real rate, basically, right? The rate of inflation. And what I found was that we needed between 12 and 18% negative real rates for 3 to 5 years to do that. So painful, yes. Catastrophic, no. Zombie inducing, no. Like life would absolutely go on. You basically would be recapitalizing the U.S. government over the backs of U.S. Treasury bond holders on a real basis. They wouldn't lose a dime in real money, but it would be a real restructuring. It would be inflating away some of that debt. So that gives us a sense. Now, by virtue of, and at first I thought we were doing that. And then we came into early 2022. The 8% inflation we were to at that point started to become a political issue for midterms. The Fed got involved. By virtue of the Fed doing that, we are now 2 years further down the road. Debt to GDP bottomed at around 119, 118, and it's rising again to 121, 122. The interest expense is increasing the deficit.
Yep.
And the point here in bringing that up is if the number was 3 to 5 years of 12 to 18% negative real rates in April 2021, in April 2024, it's probably 15 to 25%. And if the Fed wants to keep playing tough guy, that number will keep rising as the debt keeps rising. And sooner or later, it will get catastrophic. It will get very, very painful. It will get way beyond just inconvenient.
Yeah. So if you're Janet Yellen and you're just printing more dollars to deal with this, but she knows what's going on. She knows the path out of this. Is it political pressure that's keeping her from making these hard but necessary decisions? Is that your inclination right now?
I don't know. I think she knows. I think there was, when Biden got elected, I think there was a discussion of something like this under Trump. And then I think once Biden got elected, there was a view, well, maybe, we can do this sort of our version of industrial policy, right? Chips and IRA and some of the things they've done, and we'll do it that way. And so I think there was sort of this first half of the term optimism, like, oh, yeah, he's an idiot. It's fine. We'll do it our way. It'll be fine. And now we've got to the second half and it's like, the math is the math. The math doesn't care if you're red, blue in terms of your politics. Compounding interest doesn't care. And so I think there is based on her actions, in my view, there has been a growing recognition of realism around this. Some of the levers she has pulled, I think she has done a very good job of realpolitik around this. It's a tough position, right? Because you've got to, she's been spending a lot of time with China. Is it possible she's talking about, hey, okay, here's where we are. We know there's no getting out of this. We know what we have to do. Let's set the rules to this and what this looks like, what it means. I think it's very possible. There are things she could do unilaterally. I mean, if she could, basically instruct the Fed to remonetize gold, and that would deposit funds directly into the TGA, Treasury General Account, which is basically her checking account to spend whatever she likes. And if they revalued the U.S. gold by enough, she could buy back a big chunk of the Treasury market and delever us basically overnight. It's a little bit of a gimmick, kind of like the platinum coin trick that you'll hear the MMTers talk about every so often. And the difference is the MMTers talk about the platinum coin trick is like this gold trick is literally in the financial operating manual for Federal Reserve banks. Like she can do it. So I think there's a growing recognition on her part that it's an issue. I think there are domestic political constraints around inflation, around the treasury market, collateral, and then I think there are foreign creditor relationships that have to be assuaged or smoothed over, or whatever, sort of the quid pro quos worked out. I really think the meeting in San Francisco between Biden and Xi in November, we've said to clients, I think that she departed from there with the bones of what I call a San Francisco Accord, basically a game plan forward to weaken the dollar over time, and sort of the rules of the road. Hearing Xi talk about Biden sticking to the San Francisco vision, in the releases of a couple weeks ago, and I have not seen anybody who knows what the San Francisco vision was, but I don't think it was Bryce Aroni. So let's see. I don't know all those constraints that she has, but to your point, they clearly exist, and to my view, she looks to be trying to work within or work through some of those toward that end, perhaps.
Yeah. Yeah, there wasn't too many specifics that came out of Xi Jinping's and President Biden's meeting. I think a lot of the business and finance world were trying to really get into the details. Unfortunately, we weren't really able to gather much from it, and certainly Janet Yellen hasn't given much indication as well. But we can only hope that it is a coordination that allows us to move out of this deficit. So, what, we've spent over an hour talking about all of the mechanisms of the debt. In terms of rebuilding the middle class and strengthening it, we hear about Micro talking about where Americans should really be thinking about, work, the nature of work, where the opportunities are going to be in the next decade. What are your thoughts on rebuilding the middle class, and where are, the best opportunities right now?
I think in terms of rebuilding the middle class, I think there needs to be sort of a multi-pronged, multi-strategy approach toward a number of things. So I think, for example, as someone who went into finance and absolutely was cognizant of the fact that going into finance, I didn't have to study nearly as hard as my buddies in engineering, and I ended up making more money than my buddies in engineering upon graduation. And people, like Charlie Munger said, right? Show me an incentive and I'll show you an outcome. The incentives under our current dollar-centric system, highly financialized economy over the last 40 years is basically go into finance, go into business school, and they're not as strong go into where we need people to go into because the incentives aren't there. So we need to start changing the incentives around this, broadly speaking. And so when I talk about a multi-strategy approach, I think if you want to go into finance, you pay your own way in college. I think if you want to go into engineering, or you go into certain sciences, you go into certain technology applications, you should get some sort of subsidization from the government in the same way you might, as going to a state school versus a private institution. Teachers should probably not have to pay, right? If we really, we need to start and restructure from the bottom up. We need very good, very motivated teachers, not teachers who are worried about how they're going to pay their $250,000 in student loans. Because it's a disincentive. If you might otherwise be a good teacher, it's a disincentive to become a teacher. Pay for teacher school. You want to become a teacher? Great. You're gonna go to college for free, and then you make some sort of arrangement like you do with your ROTC guys, right? You say go to ROTC, you're in for 8 years. You say you're gonna become a teacher, we pay for your teacher, you're gonna be a teacher for 8 years or 10, whatever. There's ways you can do this in a way that it's not central planning or that big a departure from where we are today in certain areas. I think the approach to immigration probably needs to change as well. I don't think no immigration is not the right policy, and sort of waving everybody in is not the right policy either. I think there needs to be a recognition around, okay, where are we in terms of what skills do we need? What skills do we want to have? Where are we short? Where are we going to be short? Feels like rather than being used as a strategic benefit over the last 20, 30 years under sort of the neoliberal economic school of thought that supports sort of this dollar-centric system as it's been for the last 40 years, there's really, hey, let's just keep labor rates down so that corporate profits margins remain high. And that is a side of the labor or of the immigration debate that I never see, and I understand why I don't see it, because corporations pay all the commercial bills, right? So if you have a lot of people come in and they cap wage rates, that is really good for corporate profit margins. But if you do that for long enough, you end up with record corporate profit margins, and you end up with the wealth discrepancy we talked about earlier, where the 1% has 45 trillion in wealth and the bottom 50% have 3 trillion in wealth. And again, early on, that is fine. In the long run, that is extraordinarily politically destabilizing. And we've been doing this 40 years. We are now comfortably in the long run. And so there needs to be a discussion around, how do we get middle and working class wages up? It's a supply demand issue. Stop, targeted approach with immigration, let wages rise. If you let wages rise, you're going to let inflation rise, but you're going to flatten, you're going to equalize or the extremes and the politically destabilizing extremes of wealth and income inequality that we're currently experiencing will get less unequal under that. And it's basically having your asset holders in the bond market lose while your middle and working class wins a bit. And it's not, to be clear, it's not bad for corporate America. Corporate profit dollars will rise. Corporate profit margins will probably shrink a bit because the share to labor will go up sustainably for the first time in like 30 or 40 years. So there's some things you can do, and you can hear me kind of fumbling with it. It's not because I don't know what they are. It's because I know how some of these words will be spun when you start talking about equalization or planning or anything policy. There is a very well-oiled machine ready to basically excoriate anyone who says these words, even if it's the best thing for America and for our kids.
Yeah, I'm experiencing that challenge day to day because there's just this very clear common sense path forward. But, sticking to the details of that common sense really require us to not polarize the conversation into mere political campaign points. And we have to get there as a country. Otherwise, we're not going to be able to move together cogently, because that's fundamentally what these strategies take. Is we have to be unified around them for them to work. We have to be understanding and respectful of this process and the realities of the mechanics of our economy. And we have to be able to do so past a 4-year presidential term. We have to carry it forward for, from term to term. And they aren't issues of red and blue. They're issues of a fiscal policy, which has its own set of laws and rules. Um, so yeah, I really appreciate you taking the time, Luke, to talk this through. I think this is going to help a lot of people understand where we are and how we got here. Um, and I'm going to keep following your work very closely. And hopefully we can, start to get everyone working together versus working decisively. But wouldn't that be nice?
Yeah, I can only hope. I mean, it's unfortunately a lot of times it takes some sort of catalyzing event that pulls us all together, and I really hope we don't need that. But the financial markets, the internals of the financial markets are getting more decisive with their verdict. It's not, we're not quite to a crisis yet. We're not quite cornered yet, but we can see cornered from here, and we need some we need some courageous decisions to be made for the good of the country. So I'm optimistic because, as Winston Churchill apocryphally said, the Americans always do the right things after they've exhausted all the alternatives. And for our conversation, we're, barring a Hail Mary, we're just about out of alternatives, or we will be soon. So that's the good news, really, if you will, is that, some change is going to be forced, I think, at some point, if we don't make it ourselves.
Yeah. Well, let's hope that we can make it. Let's hope we, pick policymakers and encourage those policymakers to do the right thing. Janet Yellen sees a path forward. She just, I think, needs the right political environment to move it forward consistently. But yeah, I think all of us, what makes this country so special is all of us are following closely and we still have hope. We haven't given up hope. Um,
Yeah,
and
that's right.
this country is so full of bright, hardworking people. And that
Yeah, and
doesn't
we
change.
can, no, that doesn't change, and
Yeah.
it just really comes to getting back to playing to our strengths, which is we do have the ability to sit here and talk about these things and advocate for these things, and that's very hard to measure in terms of its value and its importance.
hmm Who do you think last question for you, but who are, besides you, of course, are the big rising stars? Like who's the next Janet Yellen? Like if you could list like 3 names or 4 names, yours included.
Mine include. I'm flattered. She's been very good. I've been very impressed with her. Who would I say? I there's like a bunch of people that I talk to regularly. I don't know if they want, that
You
are
don't have to
very,
name names, but
yeah, they like, that's the encouraging, like they're there, like they get it. There's a lot of them, and to your point, like it's super exciting because they're the old silent majority or whatever, right? I think it was a Nixon term way back in the day, and so who knows what connotation. So I don't. But there's a lot of really bright people that are very pragmatic, that are not dogmatic or overly hyperbolic about the views. That they just want to do what's right and what makes sense in a sort of centric way, centrist way, not centric way, but centrist way. It's hard not to be excited in terms of still the opportunity that those people are there. They know what they need to do. They know they can, and and they're willing to go through the bumps. They know it's going to be bumpy. They know it's not catastrophic. Like everyone's going to be okay, but we got to get going here. So there's a bunch, there's a bunch of people I talk to, and it's been actually one of the great blessings of doing this is getting to talk to some of these. But Harold Malmgren is a guy, he's senior statesman. He was been around a long time, very much a centrist, very much somebody who gets it, understands the issues, is willing to work with both sides, etc. Somebody like a Kirill Sokolov is brilliant. Just gets it, gets both sides of the issues, pragmatic. These types of voices are the types of voices you want sort of in your ear when you're talking through, because they understand the issues, they understand all of the puts and takes and levers. And once you understand all the puts and takes, when you identify the problem properly, going back to my prior point, if we have to stop telling ourselves these comforting lies and actually look at the issue, the solutions are pretty straightforward. They're not politically easy all the time, but mechanically they're not like overcomable. It's not like I can't think of a good metaphor at the moment, but those are the types of voices I think are that you want to hear. Like I said, there's a lot of others. I just don't know if they would want me to say publicly.
Yeah, I mean, it's good to know they're out there.
They are.
And it's good to know that maybe this is the next generation of fiscal policy, and we have all of the people and the resources available to us to make it happen. Final question: do you have any questions for me? Any questions for why I'm doing this? I'm curious to hear about your opinion on Bobby Kennedy and running for president, and there's been a lot of question about. I've been hearing from folks. Do I understand economics? Am I a communist? I'm not a communist. In fact, my mom specifically did not join the Chinese Communist Party and came to America as a young woman to avoid joining the Communist Party. But yeah, I'm happy to answer any questions you might have.
Yeah, I mean, I think that the way you framed is a great one. Why do this? Why are what's it can't be easy. I have no personal experience, obviously, but it can't be easy. So why do it?
Yeah, I think that there are these rare moments in history where you're asked to step into a role because the need is great. And I asked myself the real question, like, am I the right person for this? I looked into my toolbox of experiences and skills, and I thought I could definitely bring a new perspective on issues of the economy. I've enjoyed this conversation so much. I actually have a minor in economics. Econometrics was my favorite class in college. And I lived in Beijing twice, actually, once as a study abroad student, and then again working for an intellectual property law firm, a Chinese intellectual property law firm in Beijing. And I predicted, China's rise very, very early on as a young student. I knew that, going to the WTO for a summer to study was probably the best use of my time after I graduated undergrad, and then went directly from Geneva to Beijing in 2007. And so I think that there's this instinct some people have about geopolitics. It's clear you have that instinct, and it's something that you can just watch these trends, realize, where the points of danger are, where the points of opportunity are. And this is a moment in time in 2024, running with Bobby Kennedy on an independent ticket that I think really establishes many of the postures that we need in this country right now, which is centrism, which is this ideal that what makes America great is the people who are able to speak freely, think freely, and act freely. And so by doing, I think it's been a great opportunity to set an example of what the future course looks like. And I'm just one piece of it. I'm a small piece of a much larger network of Americans that so deeply want to move out of this brink of crisis moment that we've been held in for so many years. And whether it be economic policy or healthcare policy or foreign policy, there's this growing pool of individuals. That's why I asked you, I was like, who's our next generation of leadership and fiscal policy? There's a next generation in each of these categories in foreign policy, fiscal policy, homeland security. And those are the voices that we've got to be all listening to right now. And so that's why I'm doing this. And it's been a great opportunity and pleasure to be able to step into this role.
It's very exciting to see fresh faces and open dialogues about some of the issues, that you guys have been talking about. So I've been excited and interested to watch Mr. Kennedy's positions and his platform and his campaign. It is. I agree. It's a very important time. I think it's a very important time. It's a very important time to have somebody pushing some of these issues, the way that you guys are.
Yeah. Yeah, and not out of a place of hate of the other, but actually just for love of country.
That's right.
And so I think that's what this whole effort is about. It would be great if we could take office come, November after the election, but we understand we're up against a lot. And so we're just taking every opportunity every day to help shape policy through the voice of candidacy.
It's super important. It's super admirable. As I'm reading, I'm an avid reader by virtue of what I do. I'm reading The Storm Before the Storm by Mike Duncan about the Rome, still end of the Republic part of the Rome, right? So the 120 BC to 100 BC, and they're talking about how the political situation is devolving into, they're not doing things to benefit the Republic, they're doing things to sort of get the other side, right? The conservatives versus the populists. And you kind of look and go, gosh, that sounds so familiar. So to have somebody who's just trying to define the topics that, again, matter to a lot of people that aren't getting the airtime just because they're not sort of, throwing a fit. But they are fed up, but they're not throwing a fit. And there are issues that are very important to people. I think it's such a critical job.
Yeah. Yeah. And the time is now. You could make the argument in 2020, maybe it wasn't the right time for an independent to run, but given the existing options between Trump or Biden, we've seen what those presidencies look like. We've seen what their fiscal policy looks like. We've seen what their foreign policy looks like. We've seen what happens to the deficit under both administrations. So if for anything, just to use this moment to offer something new, grounded, and hopeful. It seems there's no better moment in history. So looking at it more as an opportunity than as a existential crisis. Although avoiding an existential crisis is always the goal.
Yeah, like I said, I don't think we're quite there yet, but I think we might be able to see there from here. And so I do agree with you that the time is now.
Yeah, time is now. Well, Luke, thank you so much. This was a real pleasure. I've learned an incredible amount. You are really skilled at the art of explaining. these very complex issues of debt and productivity and ratios and analysis and paths forward. So thank you so much.
Well, thank you very much for the invitation and for listening and for having me on. I really enjoyed our conversation.
I did too. We'll be in touch. Thank you.
That sounds great. All right. Thanks, Nicole. Have a great day.
Bye-bye. You too. All right. That was great.